Thank you very much for joining us at this session on Megatrends. What I think we'll start by doing actually is just ask everyone to introduce themselves, because there doesn't seem to be any way of doing it. You've got the bios for everyone, so just a name, affiliation and a shoe size would be fine.
Good morning. I'm Victor Chu, Chairman of First Eastern Investment Group from Hong Kong, shoe size 7.5.
Taimur, Hyat. I'm Chief Strategy Officer for PGIM, which is the investment management businesses of Prudential Financial, and the shoe size is 9.5.
I'm Catherine Keating, and I'm the CEO of Commonfund, and my shoe size is just a little higher than theirs.
My name is Rebecca Patterson. I'm the Chief Investment Officer of Bessemer Trust, and I think I'd rather tell you my age than my shoe size. I'm 47.
Good morning, Mike Ramsay from Generation Investment Management. I'm a partner and responsible for our credit business, shoe size 9.
And I'm Stephen Foley, the US investment correspondent at the Financial Times, and I'm a UK 8 and a US 9. So Megatrends, long-term thematic investing is our subject matter here. I was thinking about the movie Back to the Future 2 as we were preparing our panel and thinking about this notion of throwing forward your vision of the future to 30 years out. The Back to the Future, the 2 movie got plenty of things right, actually, when you think about scanning eyeballs for ID and flat screen TVs and Skyping and all of that. We don't have the tie your own shoelaces that self-tie, unfortunately. But I asked the panelists to think a little bit about 2014, about what it's going to look like, and we'll work our way backwards from those visions as a way of thinking about how we might turn those into investment ideas. And you said something very scary to me, Victor, about 2040.
Yes, it's interesting that you mentioned 2040, because some futurists say that by 2040 is the time where technological singularity will arrive. And what that means is that the fusion of robotic technology, artificial intelligence, and stem cell research, and maybe other technology, will already override the combination of human intelligence. And to some people, that is either the end of the beginning or the beginning of the end. And I think we have to factor that into account, that robotic technology and AI really will change every sector that we are talking about, and how we can be both progressive as well as defensive in taking that opportunity as well as a risk is something that investors should be very mindful of.
And one of the first session that I went to this morning was Al Gore's presentation on the shift to the sustainable economy, which is also talking about risks to the way we currently do business. So I think what we're probably going to have on this panel actually is quite a lot of overlap on the environmental and the demographic side, which would be I think an area we should investigate. But Mike, up there, your 2040 vision, very similar to Al Gore's for some reason, I suspect.
Well, he was much more eloquent than I would ever be, but the transition to a lower carbon economy, I think most people would get now is a big deal. And from the safety of the world in its broadest definition, but also a big deal in the sense that a lot of capital has to move to assist that transition to a lower carbon economy. And so looking forward, and we're seeing the green shoots of this now with my background being a credit person, a capital market person, you're starting to see the green shoots of financial product and capital markets trying to think about how that transition of capital can help the transition. So 40 years from now, I think that problem will have been solved. And of course, there's a lot of other darker things to think about when you think about 2040. But in terms of capital movement, I think that's going to clearly happen quite quickly now.
And Catherine, you're not very much in the spirit of milk in here. I think you've got some gloomy views about 2040.
I don't have gloomy views, but when you asked about 2040, the first thing I started to think about, so what happens, what's 25 years mean? What can happen over the course of 25 years? And I thought, well, what if this conference had been held 25 years ago in 1990, 1991? Well, you know, how would we have registered? We would have had a paper application, we would have filled it out, we would have written out a check, we would have mailed it in, right? I suspect nobody registered that way. This time it probably wasn't even possible. How would we have gotten here? We would have driven our cars, and if we needed directions, we would have had paper maps. If you flew out of New York, as I did, you might have had one of the very last flights in the country where you could still smoke, because it was only 1990 that smoking was banned on airplanes. Of course, today to get here, you know, you could be in an electric car, a hybrid, you could be in an Uber, a Zip car. If you need directions, it's Waze, it's Google Maps, it's your GPS. If you couldn't get a hotel at any of these wonderful hotels participating in the conference, you could use Airbnb to get a room. We would have had to network. You know, I sort of thinking about what was networking like in 1990, it was Rolodexes and landlines, right, as opposed to email, text, Twitter, and LinkedIn. You know, the global issues we would have been talking about 25 years ago was probably the unification of Germany, right? The world population would have been 5 billion people. China's GDP was about 2 to 3% of the US. You know, here we are today, it's not the unification of Germany, it's actually the question about the unification of Europe. And does that continue? The world population isn't 5 billion, it's 7 billion. China GDP isn't just 2 to 3% of the US, it's 2/3 of the US. So an amazing amount of change in 25 years. So, you know, as I look forward, 25 years from now, you know, what do we expect? I think we expect a world that's richer, right? 2 billion people or so entering the middle class across the world, primarily in emerging markets. A world that's older, right? We'll probably be approaching 1 billion people in the world over age 65 for the first time, primarily in the developed markets in China. A world that continues to get bigger, so the 5 billion becomes 7 billion, becomes 9 billion people with tremendous needs for energy to support itself. And probably, as Mike noted, a world that will be becoming warmer, you know, 1 to 2 degrees Celsius warmer than now. And so those are sort of the big themes that we think of when we look forward over the next 25 years.
Now, Rebecca, do you want to do your 2040 vision, and then we'll start seeing some overlaps? Yeah?
Sure, yeah. I mean, I would already double down on a lot of what's been said, and I don't want to repeat. I do think one thing that's changed a lot in the last 25 years, which will continue to progress, is how interlinked everything is. Economies, companies, markets, and that poses some challenges for investors if you're looking for diversification. I think that'll continue to be a challenge, and maybe a harder one even going forward. And if you only invest in US stocks, already today you can't just look at the United States. You have to take a global view to understand the inputs to that company's profit, loss, revenues, and I think that will continue. I would add to something Catherine said. If we look out to 2040, while I might make this my base case, I think that there is a decent chance the US is not the largest economy in the world anymore, that China is, from a notional GDP point of view, and that goes with the interconnectedness. How do we understand them? How do we work with them? How does it affect everything from commodity prices to technology to foreign relations? And then I guess lastly, touching on the demographics, you know, we have an older population, we also have a younger population, but we also have this tremendous movement of population. And if we think, and Al Gore was showing this morning in his presentation, the population growth in Africa, just a straight line up and to the right, versus China, Japan, developed economies going sideways or lower, and that population isn't going to stay put. I hope we're not looking at the migration crises we're looking at today, but I do think you're going to see a more heterogeneous society across a lot of countries, and what does that mean in terms of the goods and services they demand, policies, and what comes out of that.
And you're obviously thinking long term at PGIM. What is PGIM and your 2040 vision?
Well, there'll definitely be lots of surprises in 2040, but I think one of the things about some megatrends is that they're so structural and so ingrained that you can almost set your watch to them. So aging is one where several people have mentioned this already. By 2040, the world will be older, lifespans will be longer. Already about 2/3 of the world's elderly over 65 live in emerging markets. By 2040, the people over 65 in China will be larger than the entire US population now. So the world will be older, and the needs and requirements of the elderly are very different from the needs and requirements of the non-elderly, and that has investment implications. The world will be more urbanized. About 2/3 of the world will be in urban areas. That will end. It'll end at around 80%. That's what we see everywhere, that at about 80% you still need some rural population. But we'll be living in a much more urbanized world. We'll probably have 200 to 300 new cities, over 1 million people that didn't exist today or are much smaller now. And what do the cities need? And will cities be the new unit of analysis? We've seen the world breaking apart from the emerging markets to BRICS to the differences between Brazil and Russia and India and China. And I think cities will become the new unit of analysis, certainly for investments, but potentially also for economic and political actions.
So let's start trying to pull some of these things together, and the demographics is obviously one of the ones that, as you say, you can set your watch to it. So we don't have to predict the invention of the hoverboard for this one. We can actually follow it through. So one of the things I want to get a sense from you guys on this panel is whether investing in a mega trend has to be a long-term investment. Do we all have to predict 2040, as we've just done, and then lock our money away for 25 years to see returns? Or is this a series of short terms? What are you, when we think, why don't you carry on, when you think about investing on the back of these trends, what time horizons are you giving yourself to make returns?
You know, I think many of these mega trends, climate change, aging, will go on for very long. But in terms of, as investors, I think if you try and look much beyond 20 or 25 years at most, you're in the world of being a futurist.
Right.
And it's very hard to make solid investment decisions based on that. So that's the length we look at in terms of where a trend will go at its most. I think many of these trends have near-term implications within the next 3, 5, 10 years. And certainly all of them, and this is where a lot of the thinking needs to be done, have actions that investors can take now. Some are in public equities markets. I'll just take one example from the aging world is senior housing. There are REITs you can invest in senior housing. There's certainly real estate investments you can do in senior housing. But senior housing is really a big phenomenon right now only in the US. What will happen in China? What will happen in Japan? How will the UK market evolve? So there are opportunities you can invest now, but I would say our time horizons never stretch beyond 20 to 25 years, although these trends will influence humanity for centuries.
And Victor, the right thing to do is to think internationally, right?
Yes. I think one of the themes Rebecca mentioned is right. It's the impact of China to the world in the next 20-odd years. And if you look at macro China trends, many of the opportunities we can capitalize and position now. And one of the two themes that I would look at China is the flow of capital from the east to west. Because in the last 50 years, we're basically talking about from developed economies to developing, emerging and frontier economies. But I think we have already arrived at a crossroad. The amount of capital flowing in from east, particularly from China, India, into developed economies is huge. And from China, I think the outbound wealth management business will be fantastic. And one way of playing that is to invest in my colleagues around the table, because they will all be looking at beefing up the wealth management services, tackling both corporate institutions as well as ultra high net worth Chinese investors. Another theme will be what I call China Plus, is opportunities arising from the huge outbound Chinese travelers. So you're talking about hotel groups, you talk about travel groups, logistics, insurance, travel insurance. So all these opportunities, although the theme is 20, 30, 40 years, but there are opportunities now. Now, one more theme which we mentioned here is the green opportunities. Obviously, Al Gore yesterday during lunch gave a very convincing argument. 20 years ago, we looked at the green project mainly on the socially responsible angle or impact with an impact glass on it. But today, I think these are renewable projects. It's very much mainstream asset class. And we are investing in fairly bigly in energy efficiency projects and other renewable projects on a sustainable basis without necessarily government incentives. And the returns are perfectly reasonable. And I think now is the stages we should look at green project not as just a socially responsible project, but mainstream vanilla projects what we should look at a purely commercial basis, plus they're adding on societal contribution.
Well, we're gonna drill down into exactly that in just a second. But Rebecca, you mentioned China becoming the biggest economy. It's I've just come from the Berkshire Hathaway annual meeting, which was extremely interesting. It was streamed live on the internet for the first time with a Mandarin translation, and the number of side events for Chinese visitors to Berkshire Hathaway has grown extraordinarily in the 10 years that I've been going. You mentioned it becoming the biggest economy. How are you thinking about what that means for the assets that you invest in?
Yeah, I'm still somewhat reluctant to have a lot of exposure directly in Chinese publicly traded securities. We do have some, but the lack of transparency and the liquidity challenges with that market makes me somewhat cautious, and often will prefer to look for opportunities to companies that'll benefit from China in different ways but give us better liquidity transparency. One thing I love about China is that you have a government that puts out plans and generally sticks to them. I keep wanting to raise my hand and say this in one of our US government panels here. They have a 5-year plan, and they don't necessarily fulfill every bit of it to the degree they say they're going to, but there's directionally it's followed. And so if you read through their plans in detail, it does give you a bit of a roadmap on the areas you might want to be investing in. And I think that's one thing everyone, if they're not doing it already, should do. To the point made on demography in China, our equity portfolio managers at Bessemer, we manage about half of our capital internally, and then the rest will partner with external managers. And when we look at opportunities internally, things like hospitals. For every 1 million people, you have 6 hospitals in China versus 18 in the United States, roughly today. So you see, oh my gosh, there's this great opportunity. They have more disposable income, they're aging, they need hospitals. But what's already priced into the market? A lot of times these obvious opportunities are already quite expensive. So you have to do your homework there and make sure the opportunity is not already priced out, and if so, maybe you wait for a pullback. The last thing I'd say on one thing we're looking at China is through a fixed income and currency angle, so not just the equities. China is very serious about internationalizing its currency, and this has a ton of different implications, but one of them is China will continue to develop its local government bond market, and this will take years, but it's well underway. And when they have a deep liquid bond market, when people run for safety, as they did in January this year, or in 2008, 2009, they went to money markets and US Treasuries. Well, 10 years from now, 20 years from now, they're going to have another option. They're going to have another liquid, deep bond market to play in, and that's going to be China's. And what does that do to US borrowing costs? I think it means they're going to be higher structurally. I think this is a structural change. It's not going to happen tomorrow or next year, but over the next 10 years, you're going to have 2 reserve currencies in the world, not one, and that does have implications for bond investors, I think, globally. So I would throw that into the mix.
And I think one of the other things you have to think about in China, it's called an emerging market for a reason, right? The markets are still emerging. And so you have to think about public market exposure versus private market exposure. And, public markets, highly concentrated in state-owned enterprises, financial services, those sorts of things, not necessarily today going to give you the exposure to the kinds of things that we've sort of been talking about here, right? Urbanization, internet commerce, healthcare, those sorts of things are really, those investments today are oftentimes found in private markets, not public.
Right, but one of the difficulties there is, okay, if you're going to have a private equity allocation of X%, how much is China? And for all the homework you have to do to make sure you're comfortable, the due diligence on that investment versus the size of the position, is it worth your while to do that? I think structurally, fundamentally, absolutely it's the right thing to do, but when you have lots of investments you have to choose from, I think that's probably why there's been not as much direct investing or private equity investing in China as you might expect, because it seems like a no-brainer.
Right.
Yeah, I think it's probably worth just double underlining the medium to long-term question, because investors want stable returns, and so
stable, high, and no risk.
Well, of course. But unless you're incredibly lucky or with your timing day in, day out, you just can't create sustainable, long-term, attractive returns. And so in terms of what's the time period for a mega trend, it's got to be a couple of decades. But you're probably 5 years into one before you realize you're in one, and it's an investment opportunity. And so we think an awful lot about roadmaps. You mentioned the word roadmaps. We think a lot about roadmaps. And what we're thinking about there is, okay, for any particular thematic trend or industry, what over the long term, what relevant and material environmental, social and governance issues will manifest. And then when we identify a business that's stable, its current profits are not borrowing from the future, it's cognizant of all the relevant stakeholders around the ESG issues. Are they neutral to that path? Are they part of the solution, or are they part of the problem? And it's at that point that we might deploy some capital into that situation. But critically, we're matching that asset with a liability that has that long-term view. So for us, you've got to think about carefully over your timeline investing capital, but you have to be supported with patient long-term capital.
Is that going to be one of the important questions about whether you're able to take advantage of these longer-term trends? Is it having locked up money?
I think it's absolutely critical. I think the alpha that resides within megatrends is only available to long-term investors, to patient long-term investors. So I completely agree with Mike. And I think it's in the nature of these trends that if you're trying to look at quarterly returns, this is not the place to go. In many times you do need to go to the private side, to private equity or private debt. And by nature, those are longer-term investments that you need to make. But I think we firmly believe that for those who have the patience to be long-term, particularly when it's at the confluence of several megatrends like urbanization and aging, they're real investable opportunities to be had.
And I think that point about patience and capital is a very good one. Back to the sort of 25 years, time frame. One of the things that I certainly wouldn't have foreseen in 1990 is that, the retail investment market in this country would become larger than the institutional. But that has now happened. And so again, when you think about time horizons, no one's quite sure what the time horizon of an individual retail investor is, although if you follow mutual fund flows, it would seem to be about 3 years, because that's how often the funds tend to turn over. So I think there's a tremendous opportunity for institutional investors who do have a long-term time horizon. Duration is a real advantage, and who do have capital and patience to really try to benefit from some of these trends.
So let's do some of this through example, perhaps. I mean, perhaps you could talk about. Well, let's do it. Let's see one mega trend and one set of investments that you've made as a result.
Renewable projects, energy efficiency, where we go into facilities. Semiconductor factory, provide the capex and the execution of energy efficiency scheme, changing lights, chillers, and then share the savings over a 7-8 year period. And today in Singapore, Hong Kong, China, we'll be achieving high single-digit unleveraged. And when you have reasonable gearing, you're into the mid-teens. So I think for any investors on infrastructural projects, we are not talking about this as social projects. We're talking about really is reasonable commercial investment when interest rate is at a very low level. And these are cash flow generating, very little risk, because the implementation of the program is 18 months. And the savings that can be achieved is over 25 years. And you cut a reasonable deal with your host so that everybody win. The host win, the investor win, and also society wins. So these are the kind of projects which are low-hanging fruits, which I think we should really encourage across the board. In China, there are a lot of these opportunities. In the past, one has to say it's very difficult to get the right projects because, how should I say it in a very fair way, by the time it reaches investors, there are 2 or 3 middlemen in between, and each will be taking a consultancy fee. But with the anti-corruption program, all these are now much easier to do for investor dealing with the principal. So from that point of view, it's very positive. Foreign investors, including Hong Kong investors, going to China. Now, a lot of those practices have been regulated. So I think long may that last. And I think this will be a lot more healthier for institutional investor participating in that side of the business.
I mean, I think aging is another good example that we've looked at, where obviously for pension plans, there's the whole liability side as lifespans increase and your liabilities increase, and what are the solutions there. But even on the asset side, as you look back to what's investable from this universe, and we can come back to the question of what's a megatrend versus what's the subset of investable opportunities. But when you look at aging, there's real estate is one way to play it. We've talked about senior housing, but another angle is just, and this is at the confluence of urbanization, baby boomers returning from suburbia back to infill sites and town centers and wanting that work-live-play balance. And what is the opportunities in condos and urban locations as these people return to cities. We see a clever opportunity within real estate at the biotech trend. A lot of our real estate opportunities in places like Kendall Square in Boston and cities like Shanghai and Munich around the world are the specific biotech facilities that are needed as biotech companies focus on cures for dementia and Alzheimer's and Parkinson's and many of the topics that people have talked about in Milken. And then if you leave real estate, you see opportunities obviously in biotech. We see healthcare as a fairly blunt way to play the aging trade because many other things influence healthcare public companies. But you can actually target operating companies who are coming up with cures for aging or coming up with gene-based aging therapies through venture capital, through public equities in new launches, and through private debt as well.
One of the things that I think is that by investing in megatrends, you can be very prone to getting caught up in equity bubbles, for example. I mean, one of the things that I wrote about recently was the SunEdison debacle, for example. No one is saying that solar is going away, quite the opposite, but there are chances to get swept up, and you have to be very, very careful. And I wonder how one separates the right kind of investment from the wrong kind of investment in these particular areas. Are there particular warning signs one needs to look out for? I mean, Mike. Yes.
Yeah, one example I was going to give is the green bond market, and I can sort of wrap up the answer to your question in that when we deploy capital, we're typically deploying that into the private lending markets because we think lending directly to companies is a pretty attractive illiquidity premium. Having said that, our mandate also allows us to go into the capital markets. The green bond market is a very interesting one to us, and we've been more or less in a monitoring brief and in a circling pattern for a number of years until recently. So the green bond market started in 2007. The EIB issued a wrapped bond, and then the World Bank did the same in 2008. Not that interesting from a yield perspective, but it was the start. What you're seeing today is an issuance of about $40 billion per annum into that market. That's about 0.2% of the overall bond market. So clearly not enough, as it's in addressing directly the capital market solution to transition to a lower carbon economy, but it's a start. Why we avoided it at the start wasn't per se that yield comment, but the early corporate bonds that were issued with the sort of greenwashing, one, you just were not sure as a bond lender where you were sitting in the capital structure. Two, the contractual relationship that bond had to any other lenders in that capital structure was a bit grey. Three, a lot of the early bond issues that were issued by corporates, it was fungible into the overall balance sheet of that issuer, so you couldn't establish without doubt that the proceeds of the bond were going to the green projects that they were saying that they were going to do. It was going into general corporate purpose. I think that's moved on a lot now, and we have invested part of our portfolio into the green bond market. The capital market investors like the transparency of structure, contract and liquidity, and we're starting to see the investment banks support liquidity in that market. So I'm pretty optimistic about the green bond market, but we were cautious at the start. One last comment about the green bond market that's pretty interesting. In December, China issued their own standards for the green bond market. Now, there's various estimates around, but in terms of them addressing as a country the environmental issues they have to sort out, that's well over $300 billion per annum of capital required. By issuing the green bond standards, I think that's a trigger point for an expected 40 billion, again, matching the current global issuance of green bonds. There's an expected 40 billion per annum to be issued from China. So I think we feel pretty optimistic that that scaling of a capital market is definitely going to happen as it deals with the environmental crisis.
So Stephen, I think one of the things that your question highlights is what I would call sort of transition risks and transition opportunities as the world transitions to what we expect it to be in 2040. And you know, certainly in the climate area at Commonfund, our clients are generally nonprofit and public sector investors, and as you might imagine, there's a lot of concern coming up from many of our clients. You know, think of college campuses with science departments, students, donors who care deeply about these issues. And it was been really a real wake-up call for me over the last year. I went on a listening tour, 8 cities, hundreds of clients. I got a question in every single city about this, about the world aspiring to be lower carbon, and what should you know, long-term institutional money be doing about it. And it's kind of interesting when you sort of step back and you know, a lot of the rhetoric today is really in sort of 2 poles, right? The one would be divest, 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 just, you know, have no exposure at all to, in particular, reserves, you know, the 350.org and the CU200 movement. And the other is engage, right? You know, continue to invest in the normal way that you would, but engage, you know, with the issuers that you invest in. And, you know, when you really think about it, you know, there's probably something in between, and that's what we've really struggled with at Commonfund, because our clients are fiduciaries. Their obligation is to optimize risk-adjusted returns over time, and they have to think about both risks and returns. And so, as we've really thought about this and the transition to a, you know, lower carbon economy after, you know, 195 countries have signed on to the Paris Accord, you know, we really concluded that the right solution is probably not the easy solution, but it involves a whole bunch of things. It involves screening out, you know, some investments for negative reasons, right? You know, they have high levels of emissions and reserves, you know, relative to their market cap, or maybe they're, you know, coal-intensive businesses, cement manufacturing, steel, things that are probably going to suffer in this transition. But on the other hand, there are positive things, right, that we ought to be thinking about: the smart infrastructure, the thermostats, the LEDs, you know, the renewables. It's expected that renewables will be twice as much our source of fuel in 2040 as even nuclear will be as well. There'll be twice as many cars on the road, but it's thought that they'll be twice as efficient. So what are the positive things that we can invest in? How can they balance each other out? And what does that do to your portfolio? Because one of the things that we've discovered is that we've really delved into this is that you have to be careful about what you take out of your portfolio, because you can have unintended consequences. If you reduce exposure to a lot of fossil fuels and commodities, you lose a lot of inflation protection. You have to find a way to put that back into your portfolio. So, you know, divestment might be a very blunt and immediate tool, but it's not entirely clear that it accomplishes the whole objective. Engagement is a very long and diffuse tool, and we actually think the right thing is probably something more in the middle. But unfortunately, it's much more complicated.
It feels to me a lot of this is driven by the desire to push us further in the direction of the sustainable economy. And I guess we can all want it and we can all sort of see it coming. I guess the question is the timing and the speed. With a lot of capital pouring into renewables at the moment, don't you think actually the investment opportunity might be the opposite? Might be supporting fossil fuels. Isn't that where the underappreciated opportunity is?
It's really interesting. So we have seen a lot of money go into ESG, socially responsible investments. I just jotted down some numbers because I knew I wouldn't be able to remember it. But at this point, there's about 900 ESG funds. That's mutual funds, alts, and ETFs. Over $4 trillion in AUM. So it's a growing space. And for good reasons, and I'm certainly supportive of it. But I think one thing that struck me, and I don't think it's gotten a lot of media attention yet, is that about a little over a month ago, Morningstar introduced a new series of ratings for mutual funds and ETFs. So now you don't just strive to get 5 stars, you also strive to get 5 globes. And globes would reflect how socially responsible your portfolio is. And I think about what that means. And if we have this growing interest from either institutional and retail, eventually investor base, and maybe it takes years, but 3-5 years from now, if everyone's trying to get 5 globes, does that create a premium on those companies? And so you get this greater bifurcation between the so-called good companies and the so-called bad companies. Then it's just a matter of days before you get a couple hedge funds doing, you know, arbitrage on the two. And to your point, maybe people start seeing a lot of value in some of the quote-unquote bad companies. But it's interesting too, if you think about Japan, what Prime Minister Abe has done to try to get companies to be more focused on governance and return on equity. It's slow, but there is some momentum there. You are seeing companies doing the right thing, and they do tend to outperform. And if you could see the same thing on the ESG front, could you get some momentum where companies are going to get put in more mutual funds because they get a good globe score, and the mutual funds want a good globe score, and so more companies do the right thing for whether it's the right or wrong reason. So I think that's an area to watch. We're all going to be looking for globes.
I noticed the phrase "it's slow, but it's going to happen" in the way you put it. Can I sort of throw that provocative idea out here too, that the best way to invest in megatrends is to let other people invest in megatrends, whilst you carry on as you were?
I think the private equity industry will provide. They will take the front end equity risk, and hopefully. Some of their products and cash flow then can be packaged on the portfolio side for the mutual fund and other investors to come in, and they would take care of the governance, transparency, issue, which I think Rebecca mentioned. For example, it's difficult for retail investors to go into infrastructure projects in China, for example, or indeed look at Chinese portfolio companies. But the private equity investments discipline and their approach is very different, and they can mitigate a lot of those risks and then recycle portfolio products for the market.
And I don't think all megatrends are created equal. So there's some which are clearly investable opportunities now. Infrastructure, coming back to pricing on individual assets, is clearly a need in many markets now. The middle market and luxury opportunities in emerging Asia and in the retail sector is a now opportunity. But you look at some other trends. A good one is the fact that over the next 50, 70 years, you'll have 1 billion less people in rural areas of Asia and Africa. And that means that the nature of agriculture will completely change. You'll need to move to capital-efficient, large-scale agriculture from household-driven, small-scale plots. What does that mean for an entire series of industries that work on mechanization? Well, it's probably still 10 years out before we see that, so it's too early to invest. I think there's some megatrends that just need to be tracked and to see what's the right time to jump in and when there's risk on either side, and others where there are opportunities now.
I would agree on that. And like predicting the demise of the U.S. bond market because of China, if it ever happens, is a long ways off. But one mega trend we're definitely investing in right now and have been invested in, and I'm drilling down, is smart cars. So here's kind of the intersection, no pun intended, of demographics, of technology, globalization. I'd even throw in sustainability. Cars are getting smarter, they're getting safer. For older people, I grew up in St. Petersburg, Florida. I mean, can you imagine how this changed people's lives? The senior citizens, they don't have to take the little shuttle to the grocery store anymore. Suddenly they have independence. What does that mean to traffic in places like Miami? That's going to be horrific. That's a tangent. But if you think you have technology affecting cars, you have more electric cars, that falls in the sustainability category. If you can find 3 or 4 mega trends and you can find a pipeline that gets you access to several, I think you have a greater probability of success as an investor. And then you think, what are the companies that are going to service or benefit those variety of trends? So things like semiconductors, providing the technology that goes in all these cars, is something we own. We've been overweight technology for some years now, or something as I mean, it seems obvious today, but Google working on autonomous cars, where today it still seems a little far-fetched, but within 5-10 years probably becomes ubiquitous. So there are things we would own right now that touch on several trends, but we would like regardless because of where we are in the economic cycle.
I want to talk, if I can, just a little bit about the process before I throw it open to questions. It strikes me that a lot of these opportunities are cross-asset class opportunities. If you want to set up as a thematic investor, what do you have to do internally to your processes? What sort of shake-up do you have to do this properly?
So I guess the first thing you tend to think about in these mega trends are, what are the things that are going to create risks and opportunities? Could be regulation, could be taxation, could be disruptive technologies, could be changes in consumer preferences. And you unfortunately, as I said, it's complicated because you will see some of that make its way through your portfolio across the asset classes. But you also asked about, sort of time horizon, and how do you know, what are we thinking that we can do now versus what we might do in a few years versus, something that will play out, in a much longer time frame. Well, right now there are a lot of investment opportunities in energy efficiency. Thinking about your thermostats and your LEDs, right? The demand for LEDs is going up double every year. Electric cars, as you talked about, Tesla announced that they had 325,000 orders for the new Model 3. That's remarkable. It would make it one of the top luxury cars in the country. Lithium batteries, storage. So, we see those as areas, a mixture of public and private markets where you can get, good returns. Right now you talked about, renewables, and you said, a lot of money's chasing renewables. I think it's something like $1 trillion has been invested in solar over the last 5 years. But for the first time, there are places in this country where solar is competitive with the grid, even without government subsidies. And so, the opportunities, in power generation, you have to be a low-cost provider. So all of a sudden, for the first time, you're starting to see solar become a lower-cost provider. So, you have to look across your portfolio and across the country and across the world to see where you can capitalize on that.
We've certainly seen the richest ideas come when we've thrown our PMs, our portfolio managers, across privates and publics, across real estate, equity, and fixed income, and seen what comes out of that mix. And I think we understand that at many of our institutional investors, and we do believe the traditional asset class divides still make a lot of sense, that is a hard way to organize yourself if you're a pension plan or a sovereign wealth fund. And we would encourage, whether it's, they sound a little bureaucratic, but is there a task force where you get people across a pension plan from different areas to focus on how is urbanization, or how is demography, or how is climate change impacting your portfolio as one input in the decision-making process? Or do you create a multi-asset class sleeve within your portfolio where you can invest? Are there rules you need to change at the pension plan to allow private equity or other structures that might be preventing you from going after longer-term opportunities? Are you using your consultants and your asset managers like we are right now to capture all those ideas in your discussions with them? But it is a mindset shift, and I think it won't be easy, but I think it's an important one to add to the existing approach.
I think, sorry to sort of bang on about patient capital again, but I think it does come down to capital that allows you to take the time to think about your investment process and what conclusions comes out of that investment process. So using the solar market, for example, 7-8 years ago, we were thinking, okay, this looks pretty interesting. We think that Bohr's law is going to kick in. How's that going to actually present some investment opportunities? We decided to stay away from panel manufacturers and went more to the mission critical component part of the market because we felt that there would be a cost down impact to scale. And if we had been penalized for thinking about that for several months and several quarters or a year or two, then we wouldn't have come to what's turned out to be the right conclusion of where to put the capital into that megatrend. So I think it does come back to time, patience, and committed capital.
And our clients do tend to approach these things from a portfolio perspective because, again, our clients, they're nonprofits, they're public sector investors, and they tend to all have the same return target, which is something like CPI plus 5%, call it 7% or so. And the way we tend to think about portfolios, and I guess we're in California, so it's sort of apt. It's kind of like traffic on a highway, and not everybody's going the same speed. You've got the ones that are decelerating, and the ones that are accelerating, and the ones that are sort of going the speed limit. And as our clients look forward, the next 5 years or so, I think everybody thinks that CPI plus 7%, may not be so easy to attain. It hasn't been so easy in the last year or so. And so there's tremendous focus on trying to identify the accelerators and, decrease your exposure to the decelerators and trying to get the kinds of returns they need across the portfolio.
If we all believe in patient capital, do we have any sort of cautionary tales about impatient capital leaping on a megatrend and doing some damage?
I think megatrends, you have to strike a balance. There's some opportunities, as my friend Leonard just said, you can go in today. But in the mega trends, it has to be relatively patient. And by patient, I'm really talking about 5 to 7 years. We're not really talking about a commitment of 20, 40 years.
I do want to open it up to questions. We've covered a sort of a mix of topics, so let's see what the audience is interested in. Do we need?
Should we collect a few?
Let's see how we go one at a time at the moment.
Hi, David Trulio with Raytheon International. I'm curious about any trends that are driven by national security concerns. So cyber certainly comes to mind, but broader security issues, that's certainly a topic in some of the other discussions in terms of geopolitics and so on. But is that affecting your investments and how you're looking in the long term? Thank you.
Is there someone who might want to leap on national security?
I think we could have argued that's a mega trend. In a world where the internet is going to play a bigger and bigger role, in a world of blockchain, in a world where everything is increasingly connected. I mean, we're talking about people going on the internet, and I'm never going to find the stat on my page here. Yes, I have, haha. So 8% of Chinese folks were on the internet in 2005. Today it's about 50%. And we're seeing a similar takeoff, if you will, from India. So if you have a more electronic world in the future, cybersecurity, I think, equally becomes more important. It's so much more opaque. Right? How do you set foreign policy based on cyber attacks? It's much easier to move your little soldiers on the map than to figure out how that happens. And so I think it'll drive companies to continue to invest in those sorts of things. And that's probably structural. It's not even probably, it is structural. It's not cyclical. So finding the companies, and the hard part is you don't know what you're protecting against. So it's hard to pinpoint the company that's going to own it as much as thinking, let's make sure I have some technology companies or industrial or whatever type of companies in my portfolio that are going to benefit from that spend. Because from a global corporate spend perspective, it's going to continue. But I'd also think about it from a policy perspective, putting my macro hat on. How does the U.S. engage in the next presidency around cybersecurity issues? How does that affect how we're dealing with Saudi Arabia or Iran or Iraq or China. There's probably going to be implications of that that have second and third order effects that probably lead to some investments.
I think for me it's risk mitigation. So if you were to invest in a company and it had quite a long supply chain, for example, and there's a cyber attack within that supply chain, how would it impact the overall business? Or if the company itself had a cyber attack and a lot of very sensitive information was disseminated, what would the impact be? Would the company be quite embarrassed about that information that was released? So to me, it comes to risk mitigation and the governance around that risk mitigation.
Should we take a second question? I see a hand.
So long-term, near-term, aging is the demographic. My name is Jody Holtzman. I'm with AARP. And I'm really curious about, people over 50, consumer spending is over $5 trillion a year in the United States. Clearly, some percentage of the Fortune 500 have a dominating share of revenue dependent on selling to that age group. And I'm just curious, if you were to look at the Fortune 500 and ask the question of that group, which of them are dominant, are reliant on this demographic, is the investment return of that group, how does it rank against the benchmarks?
Go ahead.
Well, I was going to say, I think one of the defining features in markets like the US, like Japan, the US is probably an even better example, is the headwinds and tailwinds that will be created by an aging population and the very different spending patterns of older people versus younger people. You're no longer looking at private schooling. You're probably using less recreational services. You're probably spending less discretionary income on certain kinds of on travel. You're probably spending more on healthcare. You're spending more on fuel. You're spending more on nursing care. You're spending more on medicines. You're probably spending more on package travel tours. So it's a very different spending pattern. And I think understanding that and seeing how, as the US population ages even further, what it means for companies that will do well and which ones that will do badly will be very important. I think most of the Fortune 500, with some exceptions, are diversified enough that I'm not sure that that's too blunt a tool just to look at an aging lens at them. But I think it's one useful additional lens from which to look at companies. And I think despite this very large focus on the millennials, and for lots of good reasons, such a vast quantity of not just wealth, but spending is concentrated among older people that they will define which sectors do well and badly over the next 30, 40 years.
We mustn't extrapolate out numbers to spending either, because it's not necessarily true that the next generation of retirees is going to have the same amount of money as the current generation of
or spend it the same way,
or spend it the same way, right? I mean, do you see changing spending patterns amongst the elderly population?
Definitely. I mean, for example, if in the case of China, we've been talking about changing the growth model for years, changing from a manufacturing for export to consumer model. But unless the population is convinced that their safety net is there and firmly established, they're going to save more. So I think it really depends on the global trends as well. If people worry about their safety of tomorrow, they're not going to spend like the past or the present generation. They're going to even save more. So it's a tricky one, this one.
It is, and I would say with the Fortune 500, the one thing that they've all focused on is their own balance sheet obligations to aging and retired workers, right? So we've seen the closure of so many corporate defined benefit plans in this country as a result of that, low discount rates and lengthening life expectancies. So they've certainly thought about it from a balance sheet perspective. I would say, Taimur, one thing that you didn't mention that I think will be an opportunity for investment is just the financial services that will be needed to sustain people, through very long retirements, because they will be less and less provided by the corporate employer and more provided by their own savings, their 401ks, their IRAs, and so I think that will be an opportunity.
Absolutely.
I see one over there.
Hi, I don't think Europe has been mentioned. do you think it's almost irrelevant with, you know, a couple of the sovereign or major sovereigns there probably caught in a debt trap or anything like that? Just general comments.
There's definitely some interesting cyclical trends in Europe right now. Structurally, well, I think this June will actually be an interesting data point on the structural. You know, if the British decide to leave the European Union, is that an inflection point in the direction of Europe? I think probably not. I think it's a hiccup. But if structurally Europe is able to hold together, which would be my base case, then it's going to be an area in your portfolio you're going to be continuing to look at. Structural trends in Europe. I guess I would go back to a point I made earlier on population growth in Africa. You know, again, right now it's highlighted because of some very specific events in Northern Africa and the Middle East. But even if those didn't exist, over the next 10 years, I think you are going to see a migration, a slower one, but a migration into Europe that's going to change the population makeup of Europe. And Europe's going to have to figure out how they cope with it or not cope with it. And I think that is more of a structural than a cyclical issue, and probably one that's underappreciated by the markets today. I think there's a good chance they can cope with it, but it's obviously proving difficult right now, just given the degree of the migration coming in.
Does anyone else have any views on Europe?
Yep.
Well, Scotland might have another crack at going independent. Look, I think the vote will be very interesting. I think I kind of agree. I think if the UK does vote to leave the Union, we can't forget the trading relationship with the rest of Europe and the UK. So I think the economic equation is probably overplayed by the stay-in camp. I think that, however, the European Union and the fiscal union of the euro is a bit of an experiment. And I think the global financial crisis and the impact and stress that's put onto the European Union is not done yet. And so I think how supportive Germany and France, I would say in particular, are, where you need massive wealth transfer within the union, is not done yet. I think the immediate issue is around the migration issue, and that's not done yet. But the underlying economic and fiscal union, leaving UK to one side, I think is still to play out.
And that general discontent as well. I'm afraid we're going to have to wrap it up because I've seen the warning. But that sort of generalised discontent with the integration process and with the political elites that have been leading it, we may find, I know you call it a hiccup, but we may find that this is the early stages of another mega trend of de-integration and perhaps even deglobalization, but that will be another panel, presumably. I do apologize that we've got to wrap up, but thank you very much for the questions, and thank you very much to the panelists.